It isn't easy to stand apart from the crowd. There's safety in numbers, or at least we think there is. Strong behavioural biases mean we tend to feel more comfortable when we know lots of other people are doing the same thing that we're doing. Yet in investing, this can be exactly the wrong approach. Some of the most famous investors made their names by being the odd one out. If you know your investing history, you'll know the names of Benjamin Graham, Warren Buffett, Fidelity's own Anthony Bolton, all famous contrarians with blockbuster investing records achieved by going against the grain. So, what does it take to be a contrarian investor? Is it still the best approach? And what are the best contrarian opportunities around right now? To answer all of that, I'm joined by Andrew Oxlade, my colleague here at Fidelity and proud non-conformist investor. Andrew, welcome along.
Thank you very much. Glad to be here.
Lovely to have you. First of all, lots of investors say that they want to be a contrarian. I've mentioned those famous names there. But few really manage to do it. By definition, you have to be in the minority, I suppose, to be a contrarian. Why do you think it is so hard to be a true contrarian?
I mean, I guess is the thing that's at the heart of it is the cognitive biases that we all have. So, and that's why to some degree it's actually hard to spot when something that is contrarian, because we all kind of believe it and see it and we lean that way. So you get these opportunities where a story develops around something and then it becomes all very negative, everything gets sold off, and we all sort of believe that it becomes the orthodoxy. We all believe that story, and that's what provides those golden opportunities. And likewise, when things become overpriced, it basically becomes justified. It becomes a thing, doesn't it? Where people say, yeah, but it's different. This time it's different. The most dangerous words in investing. This time it's different. And actually, the US is on a very high valuation, but that's justified because it's got great prospects, etc., etc. Mm-hmm. Very hard to see through those sometimes.
Yeah. And if it's just almost a truism to say, if everyone's doing something, we just take comfort in that and we just think, well, they must be right. If the majority is doing something, then it must be right. And I think there's also something where if we get things wrong, we're happier to get things wrong when we know everyone else has got it wrong as well. You don't like being wrong on your own because you just sort of feels extra worse.
That's true. The
somehow.
Security, going with the herd is the easiest thing to do. And that's largely what most people do. That's what creates the opportunity.
Yeah, and of course there's things like FOMO. Everyone's familiar with that phrase now. But
absolutely, yeah.
That's basically the same thing in effect, isn't it? That you see other people gaining and you kind of want to be part of that. I mentioned those really famous investors, Warren Buffett, of course, probably the most famous, Anthony Bolton around these parts, very famous investor. They're often referred to as value investors, and this sort of contrarian value thing is sort of interlinked, isn't it? Explain how the notion of value in investing works and how it relates to being a contrarian.
So it's interesting you mentioned some of those, because even within the world of value investing, there's some debate around who is and who isn't a real true value investor. But let's start with value investing and what it is. So essentially what you're doing is filtering down the sorts of shares that you might buy, but it could be stock markets, industries, however you want to filter it. Mm-hmm. But largely fund managers will be filtering down types of shares that fit a certain profile that they're looking for, and that will be largely based on things like price to earnings ratios, which is basically a measure of profits against the share price. Mm-hmm. So the lower the number, the better. The higher the number, the more expensive it is. And so that's just one measure. There'll be lots of measures that some of these fund managers will be using, and from that they call them their screens. Basically, they'll have screens that will tell them which are the cheapest stocks in which to buy it, and then what they try and do is put aside all the noise, all of the sort of negativity that may have built that story, and then and buy off the back of that.
Yeah, and that so they're numbers basically that can kind of flesh out and make real, an asset's sort of value, whether it's highly valued or lowly valued, right? And it's, so as you say, there's dozens of these measures, and you can get as kind of technical as you want on this sort of stuff. But you mentioned a couple of, price to earnings, probably the most common, very easily obtainable for most stocks. Often for funds, for whole stock markets, they'll have a figure that tell you basically what is the price of this thing versus how much money is being made. And you can compare different assets on that basis, right? And some are going to have a higher value on that basis or a lower value on that basis. The value investor is going to be looking for the more lowly valued ones, right?
Exactly. And I think with those, with those fund managers, they take this very seriously. And having met quite a few of them, and some are quite kind of. There's a lot of zealotry around being a true value investor. And so Warren Buffett is an example of that, where he was considered to be a value investor back in the day, the 60s and 70s, when he was setting up his empire as such. And then in more recent years, it's probably more questionable about whether he is. And of course it has, and he's sort of struggled to actually find anything to invest in anyway. Yeah. Even if he is a sort of mild value investor. Yeah. As he is these days.
Yeah, that kind of, in this kind of Buffett law, it's sort of those early days were the cigar butt investments. Have you read about this? Where he's sort of basically picking up cigar butts off the ground where there's still a tiny bit left. So basically stocks that people genuinely unloved things.
Totally, yeah.
Unloved. Yeah. But where he sees some value still there.
Exactly.
And it changed. And then later on it became, well, actually, Apple, you wouldn't describe as a cigar butt, but, on certain bases, it's, good value. So kind of reasonable quality investments, but at a good value as well.
Exactly. And you hit it on the head in the sense of it's the stuff that everybody doesn't want. This is the unloved investments. These are the things where there's such a strong narrative has developed that's pushed that share price down. There's so many examples that we can go into and talk about, but it's a real kind of enough sentiment to have beaten the stock completely down to the bottom. But there is always the danger of value traps as well, this is where you get this sort of situation where they are very lowly valued, but actually there needs to be a trigger to revalue it. Yeah, and sometimes that lacks, and so a true value investor will hold on. They'll be aware of value traps, and you need to be mindful of that. But they'll hold on, knowing that there will be that trigger at some point.
Yeah, and this gets to the heart of why contrarian investing and value investing is hard, because if something's lowly valued, by definition, the market thinks there's a reason it shouldn't be valued higher than that. So there's lots of information. There's a story, as you say, out there for why you don't want to buy this asset. But as the contrarian, you've got to have a low price and also a theory for how that changes, I guess, or like a catalyst, they sometimes call it, for how that changes, and that value is then unlocked. And if you don't have that, you've just got a cheap sort of rubbish asset, right? You need the market to be wrong. That's the hard bit.
Well, it's quite often that that these opportunities are probably more fleeting for the ones that so let me give you an example. So Burberry make the great Czech
luxury handbags,
a bit like your shirt actually.
Big in the 90s.
Exactly. Very, very expensive clothing. Had a huge market in China that was growing very fast. Couldn't have been going better. The shares had soared, hit £25 a share in 2023. And then it all went wrong. And it went wrong because of concerns around Chinese spending and whether they did have, the luxury market, how fast that was going to grow to support that. So those shares tumbled and tumbled. Nick Kyrgios, who's a value fund manager at Schroders, he sort of spied that at around sort of £11 a share, I think it is. And then as they carried on going down, he carried on buying and buying and buying, went down to about £7, and then they started coming back up again. And so even for somebody like that, he's spotted an opportunity, but even when they're buying, they're still falling, and they have to remain committed to making that, to sticking with it and then waiting for it to come back. They have come back. They've come back only up to about £11 or £12 now. So there's already money being made on the way down. But my point being is that these things are there can be a short V where people take opportunities.
And in the case of Burberry, then. You don't know any of this is going to happen when you buy, but you can look at it. It's a very strong brand. It's got a history of being sort of, very successful and desirable, these products. That investors will often look at that kind of thing, won't they? What's of value in this asset? What am I buying that's still going to retain its value? And the tide can turn. It's often a waiting game, isn't it? And
exactly. Your point on brand is absolutely spot on. It's the value. What's the value in the company? Find the value in the company. Another example is Mercedes and Tesla.
Oh yes.
Mercedes and Tesla is a brilliant one. This because on one side you've got Tesla. That everybody knows the shares there have soared. The growth of the company has been phenomenal. So they've grown to an extent now where the price to earnings ratio on Tesla, because it's taking over the world and it's going to wipe out every other car maker, if you believe the story, and it will be completely dominant. So its price to earnings ratio is now around 130. That's extremely high for any company.
Yeah, let's put some context there. So like 20 would be a sort of common.
So the average
PE.
for the UK stock market is 12, and for the US stock market is 21.
Yeah,
exactly. So if you think of that as the average, and this one's on 130.
Yeah.
Mercedes, which is a car maker that's been around for 140 years, with an amazing mark and prestige. It's a top 10 car maker in the world, and one of the biggest luxury car makers. That is on a price to earnings ratio of 5.5. So 5.5 versus 130. Now there's a huge difference. So and maybe it's right. Who knows? Maybe it's right, but the value investor may see that as an opportunity.
Yes.
To take advantage of a story that is Mercedes is never going to be able to compete properly with the likes of Tesla.
Yeah, and that's a really interesting example, because the market there is saying one of these companies we regard as the future, and so therefore we're going to pay up lots for that, and one of them we regard as the past, perhaps. Not to say Mercedes can't, make electric cars or what have you, but they're, Tesla's clearly cornering that market. There's loads of ways that story can go wrong. Tesla will, anything could go wrong at Tesla. And then you've got Mercedes, maybe they make the best electric car next year and that suddenly becomes desirable and they have that great brand. There's ways you can see that story sort of changing, right?
And they often call that being, price to perfection, isn't it? It's basically there's no room for error there. And we've seen it with the Tesla shares have come off a lot this year. I mean, it's obviously linked to a lot of the stuff that's happening in the US, but exactly that. Yeah. I mean, you need to be able to see through the stories and be able to work with the facts to be able to do that. Yeah. Now, this is all quite, for those who are into picking individual stocks is one thing, but I mean, I think my approach to contrarianism is probably milder. That those things may happen around the edges of a portfolio, but actually I think the important thing is within your core, isn't it? It's where the core of where you're investing, to just lean it gently.
Yeah, and this is often the way it goes, right? With personal investing, it's not like big swings into this or to that. It's just little nudges to push the balance here and there.
Exactly. So I think the levers, the most common lever open to people is where are you spreading your money geographically, for example. Yeah. So if you think about the fact that the US is a very major part of any global. So if you're invested in a global stock market tracker fund, an index tracking fund, the vast majority of that will be in the US, possibly sort of 50-60%, depending on which type of tracker and how it's run, et cetera, et cetera. Now that's a way of balancing and offsetting that if you're concerned, for example, with the fact that the PE ratio that we just talked about for the US is 21, which is very high and very high against its historic context. Whereas the UK is 12, Europe is 13 or 14. These other regions are much cheaper. Emerging markets are even cheaper than that. Now you can therefore keep your core in you want exposure to the US because that story might be true and it's been a great market, etc., etc. But what you're doing is just tilting slightly more towards other areas. So, for example, for my own, I probably had 5 or 10% in the UK a few years ago, and I've just increased that. So now it's around 20%. Yeah. Because of this, and the story, the story with Brexit is that. The story with the UK is Brexit, which is that Brexit's done this damage to prospects for the UK, and therefore it's been cheap ever since then.
Yeah, and this is why. I think people listening to this and thinking about how can I go about it, it's not quite as simple as saying, well, what's the PE metrics for all the major stock markets? I'm just going to go for the lowest of those numbers. You need to understand how those have changed versus history. And you mentioned an example there. US is high, but also high versus its history. And in the UK, as you say there, the story has become, well, something is a bit broken in the UK. Productivity isn't as high as it once was. Therefore, the valuation on the stock market just deserves to be a bit lower than it should be anywhere else. That's coming into question right now, actually. And so we've had, since this year, not just the UK, but other European markets have kind of risen much more strongly than the US. So a slight kind of unwinding of that kind of story, right?
And who knows how that's going to play out. I mean, this is, again, could be a classic value trap, couldn't it? Maybe the story's right. Maybe the UK's prospects are that much more diminished now that it justifies that lower rating. But the important thing is, I think, looking at the dynamic around. So if you take PEs and you spread them over 10 years and smooth them out, they produce another measure called CAPE. And there has been quite a lot of research. This stuff is never sort of foolproof, but some research that shows that if you're buying stock markets with a low CAPE,
a cyclically adjusted price to earnings ratio.
That's the one, the easy word soup that we like to throw around in the industry. It's a smoothed out version of the PE ratio. If you take that, and it's the low figures typically lead over very long periods to the best returns. When the figure is high, it's but the other way around. And so even if, the triggers feel like they're not there or may not happen, the evidence suggests that you'll probably get higher returns from those markets when CAPE is lower. Yeah.
I just wanted to mention emerging markets here, because one of the things that you'll often see with emerging markets is that they are traded on lower valuations. Part of that, you can argue about whether this is still true, but part of the reason traditionally has been, well, in certain markets, you have to have a bit of a discount because transparency isn't as good, governance isn't as good, the information you're getting to base your pricing on isn't as good. So therefore, China, for example, will always be a cheaper market than the United States. There's those things to bear in mind. So once again, you need to check, maybe it's CAPE or just looking at what the price to earnings has been in the past. You need to have an opinion about that, don't you, as well? Is that discount still fair? Is it, what will you accept as a discount?
Totally. Yeah, I mean, it's a good point around emerging markets, but I would suggest those are just more stories of.
Well, they are,
and it's whichever way you look at it, isn't it? So you could argue that maybe the PE should be higher, given that those are high growth markets. In terms of economic growth. Which, whilst not directly linked to stock market returns, has an influence over time.
Yes.
So you will find that that those markets should have great growth potential. And back in the noughties, they were on very high PE ratio, some of those EM markets, because they did really well. But they've been in a very long period now of not doing very well. But that's kind of what you're looking for. And of course, this does also, should say, this is all dependent on your time horizon. So if you're, you may be having to wait a long time for these things to
I was going to say, because the experience of value investing and contrarian investing is that you have to sit in a pretty uncomfortable place for a long time. And then there might be a short period when suddenly it's your day in the sun. The start of this year has been for European shares, for UK shares versus the US. It's been a big rotation. You'll sometimes hear that phrase, a rotation, a sort of reversal of the Tory. That can be what it's like, right? To be a contrarian, you have to you get your performance in short bursts, perhaps.
Exactly, and it's very easy to get overexcited and think this is now the moment, and then often that doesn't happen. But I think it's you have to hold your nerve and ride those out.
And just in terms of the reasons why it has been so hard, the US market has just dominated, hasn't it, for ages. But 2 really, really, really strong years for the US, but that comes in the context of 15 years, really since the financial crisis, where it's continued to be among the best or the best performing markets. That's hard for contrarians, isn't it? Because the non-contrarian position has been where you want to be. So it's been hard to be a contrarian.
Exactly. That sums up why it is so difficult. And from my own experience, as I said, I've been waiting more into the UK for a number of years, i.e. years when the UK has fallen way behind the US in terms of the returns. So you'll get these periods where it will be lower. It will be trickier to do that. But you've got to step back and look at what's going on at the US at the moment. We've got this kind of concerns around trade tariffs, etc., all being added, but it's kind of noise around the fact that the PE is so high and the CAPE value as well is so high for the US. And when you're stopping and looking at that, from my own perspective, I'm thinking, well, just how do I rebalance a little bit away from that? How do I find areas that have got better value? And in the short term, that may lead to underperformance. It has done in the past, but over a 10 or 15 year horizon, that should level out.
Okay, well,
never any guarantees, but it should.
No, there are. Before we wrap it up today, just wanted to talk about one more example of valued opportunities. We've covered loads of them actually already, but one people will be familiar with this story: commercial property, and in particular office spaces. We're able to invest in commercial properties in all sorts of ways. And the pandemic was a big upending of that entire sector. And since then, it's been very unloved. So tell us the story and how that changes.
Well, I mean, I think this is the fun bit, right, about being a contrarian or value investor, is finding things in the world that where there's a very excitable story. And that's what we've seen with commercial property. So we obviously had the pandemic, we had the everybody work from home, and then we've had the creep back to the office. And in all of that, if you look at the values of commercial property, they've really suffered in that period, as you would expect. However, is the story overdone is always the question. And there's some investment trusts or one way to access that part of the market. And there's some very wide discounts because they trade a discount or premium to the value of the actual assets that they hold. So you've almost got the values themselves being depressed, and then the market's measure of that being even more depressed. It's almost like a double discount. And so the contrarian may feel that, well, actually, what I'm noticing is that there are a lot more companies going back to more days in the office. There was a story just last week on the FT about soaring demand in the square miles and in the City of London. So maybe that story is beginning to change. And again, what you're looking for is sort of lags where it looks like that is genuinely changing and there's an opportunity, but it's certainly an unloved sector. Yeah.
And this is what the value investor will always look for, kind of mispricing, lags, as you say. And in commercial property, you really do get it because you've got this story of what's going on in the sector, people form a view, and then prices take a long time to change because it's not like a share, is it? It's not like things are being bought and sold every day. So it takes a long time for those prices to shift and perceptions of them. And you can get rapid re-ratings of something like a property trust. Once that sentiment changes, right?
Exactly. And like you say, it's the assets they hold is often the actual buildings is the investment. Like when you look at other funds and you see the shares as the underlying holding, they're actually, some of them will physically hold the property. So as you say, trying to value that stuff is notoriously difficult. And that does add a layer of risk as well into what you're doing here. But it also means it creates that lag opportunity that you talked about.
Okay, well, let's wrap it up. But before we do, you've written about all these things. So tell us about that article and also some of the ways people can basically get exposure to these contrarian value investments.
Well, I've written in the article what gave me the idea was I did have some management training not so long ago, and the woman who was training me said, "You've got quite a non-conventional approach," which I sort of took as a compliment, but I'm not sure it was meant as such. But it made me realize, I do this in investing as well. So I talk about that in the article. I talk about funds that give you value exposure. And there's some fun recommendations from our fund suggestions from our select 50 list.
So someone else can do this for you, basically.
Exactly.
A value investor.
Exactly. If picking shares isn't your thing, or this all sounds too much, then the fund managers will do that for a charge. Will do that for you. And also, there's lots of other things, observations within that article of things that are fast moving at the moment, where I've been certainly things that have caught my interest.
Fab. All right. Well, I think that just about covers it, Andrew. That is all the time we have now. Thanks for coming in.
Thank you.